Okay, welcome to the October 3rd edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a bit about the Fats and Oils report that came out yesterday, and some of the changes that it looks like that report implies for the fundamentals of the soybean oil market, of the U.S. domestic soybean oil market anyway. For a lot of the past couple of years, I think myself and maybe some other analysts, but certainly I have predicted a sort of sharp decline in soybean oil stocks that at times implied we were going to import a bunch of soybean oil from other countries, or at least that was sort of the way that I represented it in my balance sheet projections. It wasn't something that I believed generally we were going to need to import a lot of soybean oil. I'm not sure I ever 100%, or a lot of vegetable oil. I'm not 100% sure I ever believed it was soybean oil. But anyway, frustratingly, the fundamentals never seem to follow that pattern or to start to make those shifts, despite the growth in renewable diesel production capacity that was obviously coming online. And over the last several months, we've seen a sharp uptick in soybean oil use in feedstocks and really feedstock demand more broadly. If you look at almost any of the feedstocks, the last several months have featured record feedstock demand for almost all of them, which makes total sense given the fact that we haven't had we haven't had substantial and lasting pressure on biodiesel margins, and we have had the growth in renewable diesel production. And so that feedstock demand, I guess, was always going to be there, but the way that it worked out, it came on a little more slowly. And I think the crushing industry had a little bit more time to adjust, and soybean meal demand was strong. And so the crushers have done a good job of maintaining adequate supplies for all of the demand growth that has occurred. And it looks like that period of fundamentals, I guess, might be coming to an end. Now, again, let me just say that this is something that I predicted for a big part of the last couple of years, and every year we would get down to about this time of the year, which is usually sort of when we would predict that stocks would start to tighten up and stocks would be well above our expectation, and then kind of stay at that level, or maybe drop down a little bit, but not as tight as we expected them to be. And I think that yesterday's fats and oils report kind of signals that might be changing. All right, so let's get into it a little bit. So we got the fats and oils report for August. You can see that crush slowed in August relative to last year and relative to the 5-year average. Part of that is certainly because we've seen a sharp slowdown in domestic soybean meal demand, at least relative to where we were the last year and even earlier this year. And so if you look at domestic meal demand, which we'll do in the next chart, you'll see the slowdown. And what that does really is it means that there's a change from what's driving crush. So historically, as I've said before, crushers matched their crushing volumes with meal demand and then kind of try and figure out what to do with the oil. That's not really true. That's a little flippant, but that's kind of how it worked historically. And now with the growth in oil demand, the idea was, okay, well, oil share is going to need to rise, and ultimately crushers are going to need to match their crushing volumes with the oil demand, because it looks like the oil demand probably will be larger, more significant than the than meal demand. And so over the last year and a half or a little bit more, record meal demand meant that crushers could crush. They produced a lot of oil. And so the growth in renewable diesel feedstock demand didn't really have the same impact on soybean oil fundamentals or soybean oil stocks as it might have had otherwise. And that didn't obviously stop prices from going way up and coming way back down. So it's not so much that now that this shift is occurring, I expect prices to take back off again and go up to 90 cents. I do think it will probably provide a little bit more support, and we may end up lowering our raising our price projections a bit based on this data. However, the larger theme of a huge South American crop weighing on soybean prices, which ultimately weighs on soybean oil prices, is still sort of the main driver of my outlook. You can see our forecast for 23-24 crush. We expect record crushing volumes pretty much for nearly every month. Now, again, this one might be a little optimistic, quite honestly. We basically have set crush close to where we think industry capacity is going to be, and that tends to be a little high, at least historically. Maybe this year will be the year that they crush to capacity, but at least right now, we need all of that soybean oil supply to meet our feedstock demand. So I'm not really super fired up about lowering the crush forecast. However, I do expect that I probably will lower it modestly as we go through the year. I relatively sure that we'll have a crush number for 23-24 that starts with a 2.3 something, and whether that something is 75 or 25 or 15 or 50, I think we'll sort of figure that out as the year goes on and figure it out in the first couple months of the year. But it's going to be, it looks like we need all of the soybean oil, and so crushers are going to be crushing as much as they can in 23-24. That said, with meal demand slowing, it may be crushing all that they can, sort of almost begrudgingly, I guess. Crush margins are still good, so I don't mean to imply that like the crushers are going to be suffering. I don't think that's the case. I don't know that crush margins, as we talked about a couple of weeks ago, I don't know that crush margins are going to be where they have been, but I expect them to remain elevated. And so if the data for August does actually reflect sort of this change in the fundamentals for soybean oil, I think it kind of fits in with a bit of what we've seen in prices. So if everything is moving from an equilibrium that was set after the initial biodiesel build out, where prices ran up to 60 cents from 20 cents and then came back down and settled at 30 cents. And this time we ran from 30 cents up to 90 cents almost. And now it looks like we're going to settle back down around 60 cents or maybe a little bit below 60 cents. 55 cents probably is the middle of that range. Then I think that the shift in the fundamentals also is part of that process. And while that shift generally is bullish for soybean oil, the way that the prices respond makes sense. You get a lot of speculative fervor, then that calms down. The prices trade in an equilibrium range, reflecting the fundamentals. And if you had just taken the fundamental outlook year by year and you went from relatively ample stocks in 21, 22, and even a bit in 22, 23, or let's just say 21, 22. And then in 2023, you ended with the fundamentals that it looks like we're going to have in going forward. It would be bullish, but you would be jarred because in that case, the price would jump from 30 to 60 in response to that change over a relatively short period of time. We've had essentially 2 years to sort of figure this out and price this in, and prices ran up to 90, and now they're coming back down to 60. And so even though these changes are a bit bullish, it doesn't necessarily mean that the prices are going to respond in the same way they would if this was just a change that that happened again sort of recently that the market hadn't reacted to yet. All right, so soybean meal demand. I know this chart is a bit busy, but you can see the gray bar is last year's average daily use for U.S. domestic soybean meal. And last year we were at or close to record demand for quite a bit of the year. And this year that has slowed. And particularly over the last couple of months, you can see the year over year decrease. In August, the decrease just kind of brought us back into where we traditionally were. In July, we were a bit below that level, but you can see there's a big difference between July and August and the rest of the year, when the red bar was either well above every other bar or close to or close to the top of the other bars. March is about the only March, January, and December, I guess, are the primary exceptions to that. But over the last 2 months, it does feel like there has been a slowdown in meal demand. Now, we're still predicting that meal demand grows from 22-23 to 23-24. However, that's primarily due to the fact that based on our crush forecast, we have a lot of meal that gets produced that we're going to need to use, and the choices are either the domestic market or the export market. The export market will probably be have a larger impact on margins, because I would assume that export basis probably will come under pressure as crushers start to crush more for oil and less to meet meal demand. And that's kind of why that part is important, because you can store meal, but not as long as you can store oil. And so the marginal pound of soybean meal produced, or I guess the marginal ton of soybean meal produced, will not necessarily have the same impact on price as soybean oil. So for soybean oil, you can put it in a tank and you can store it for a couple of years. For soybean meal, that's not the case. And so you kind of have to move it out. And if you can't move it in the domestic market, then you have to price it to sell in the export market. And I think that's what's going to happen. I think 23-24 could be the year where we finally see, again, crushers matching crushing volumes with veg oil demand, overproducing soybean meal demand relative to domestic demand, and then shipping that excess out into the export market, where it will need to get priced and will probably price a little bit below where the domestic market is. And so that's really important, because it does have an impact on crush. If you look at this change in meal demand, and you look at the change in crush in August this year, that's kind of what you would typically expect when meal demand slowed from monthly crush. So if meal demand is going to remain slow, crush probably is going to remain a little bit weaker, and that may be the initial cut to our 23-24 forecast. Might be those first couple of months where meal demand remains relatively slow, and crushers don't necessarily need to crush to meet oil demand. And so they can crush a little bit, they can crush a little less. Margins are still good, so obviously they still want to crush, but they also don't want to provide so much supply to either the meal or the oil market that they break basis and cut into their margins. Whether they can continue to kind of hold that up going forward is going to be something that will be pretty interesting to watch. And I think that given the growth in demand, they probably are going to be able to hold up soybean oil basis, even though it's been really, really weak recently, or been moving lower recently. But probably, again, probably not meal basis, because they're probably going to have to price meal in the export market to move. So crush is going to be really important for the soybean oil market, obviously. And given our expectation for the crop size, that means that soybean exports are really going to have a significant impact on not only on sort of the soybean market and soybean carryout, but also on the meal and oil markets. And again, much like Canada in recent years with canola, and the US a little bit last year, but probably much more going forward, the choice is going to be between crush and exports. And any change in supply will have a more significant impact on crush or on exports than it will on crush. So if we cut supply further, just like USDA has done the last couple of months, they tend to cut a lot more out of exports than they do out of crush. And that's because we need all of the soybean oil. So this is our forecast for 23-24 crush. It's based on 1.525 billion bushels of exports. When talking to people about this number, a lot of people think that it's probably a little bit low, and ultimately, again, it might be a little bit low. However, if you get a return to normal yields in Brazil and Argentina this winter, our winter, their summer, then there's going to be a lot of supply that is available from South America that will mean that the industry doesn't necessarily need US imports. Of course, China is the biggest country and the most important country on the import side of the soybean market. And so how the volume that China imports and then the volume, the split between their imports from the US and from Brazil will have a significant impact on whether this number is 15 or 1.525 or 1.7 like USDA says, or 1.8 essentially like USDA says. I think that based on what we've seen recently in China, it does seem like their meal demand is starting to pick up a little bit, and their import demand is starting to pick up a little bit. Still much more slowly than I think a lot of people expected, including myself. But I did have to raise my prediction of Chinese soybean imports for 22-23 and then 23-24. The key there that isn't necessarily something that would be sort of the typical fundamentals or the Econ 101 fundamentals, is that China will probably have a political preference to import soybeans from Brazil. Now, China will never just buy from Brazil or just buy from the US for a lot of different reasons. Mostly when they're really, really going, it's hard for them to source enough volume from either country to meet all of their needs. But even when they've been a little bit slower, like they have the last couple of years, one, they maintain relationships in both countries, so that if there's a problem in one country, they still have the relationships in the other country, and they can increase exports from the other country. Going forward, though, I think just politically, China probably will favor Brazilian exports. And so that gives US exports a little bit of room to come down. in addition to politically, probably the U.S. soybean export basis may not ultimately be super competitive. Maybe it will be, but just generally, given the crush demand, U.S. export basis might also be a little bit less competitive. But I think that the primary driver for a shift in the portion of Chinese imports that come from Brazil versus come from the U.S. will be the idea that that they would like to support the Brazilian economy and further their relationship with Brazil. The BRICS group seems to be forming closer bonds, and importing soybeans from Brazil is certainly one way to ingratiate yourself with the exporting country. And so while our forecast is low and maybe a little bit too low, I do think that USDA is going to need to lower their forecast as we start to get into the year and get into soybean exports. If not, let's say that for whatever reason, China needs to import a lot more soybeans from the U.S. than everybody expects, then you will either have a situation where China will crowd out exports for other countries. So we still only export 1.5 billion bushels of soybeans, but a bigger chunk of that total goes to China than the 5-year average would suggest, or whatever. And in that case, then I think that you would start to have an impact on crushing volumes. I think that the scenario where U.S. soybean exports really start to disrupt crush and really have a substantial impact on the soybean oil market, the probability of that is probably really, really low. So I don't know that I think that is going to happen, but it is in the extreme case. If South America had another drought this year, of course, China would need the soybeans and they would have to do that. But I don't think that that's going to be their preference. So I think that it works out so that China can, or U.S. exports can kind of decline a little bit more than they have in the past couple of years. And ultimately, as the U.S. becomes more and more of a domestically focused market, I think that it provides an opportunity for South American exporters, and it also provides an opportunity, I suppose, for U.S. farmers. So if U.S. farmers can really overproduce soybeans relative to the last decade or so, then there can be enough soybeans to export and to crush. And honestly, it probably wouldn't take that many years to get back to sort of burdensome U.S. soybean stocks if we have a couple of years of good weather and farmers plant more soybeans than they did this year, which I think that'll happen. I think this year was a little bit of a special case, and I think that the 4 million acre change from prospective plantings to the June acreage report kind of reflects that. You get big changes, but that was a pretty significant change, and not in the direction that I would have picked before the report. So I think there's probably a little bit of bounce back anyway next summer, and ultimately that won't change the 23-24 outlook, but for 24-25, it could be that instead of the U.S. market becoming more and more domestically focused and soybean exports sort of following the path of soybean oil exports, it may be that we start to build stocks and then we can export as much as we need or as the importing countries need. But still, exports are, at least in the short term, and over this summer, exports are going to be a key, over this fall, exports are going to play a key factor in determining how much, whether there will be enough soybeans to crush. And that question really gets answered in the third quarter of the marketing year that sets up the final quarter and kind of lets us know whether we're going to have enough soybeans for the fourth quarter. And so I bring this chart out again, which shows sort of Q3 crushing volumes, and then the Q3 crush is a percent of the prior quarter's ending stocks. And I expected this to be a little bit different when I put it together. And so the reason I showed it is because primarily of that, because I would have bet, even though our new crop ending stocks only declined by 10 million bushels relative to our old crop, our prediction for 22-23. So stocks are still going to remain tight. And I would have thought that that Q2, Q3 stocks probably would have been a little tighter in 23-24 than 22-23. But it turns out, well, they're a little bit higher than 22-23, and the portion of the Q2 ending stocks taken up by Q3 crush remains pretty much unchanged at about 34%. So it does look like there will be sufficient soybeans to crush all that we need to crush. However, that is all based on the idea that we export 1.5 billion bushels of soybeans. And so if we do more than that for the marketing year, then this chart will probably start to change a little bit. And so if we export more than we expect, Q2 stocks will be lower, Q3 crush will be a larger percentage of those stocks, and will probably exceed where we saw the portion in 2021, which is a little above where we are for 22-23 and where we expect to be for 23-24. That will help support prices, soybean prices, and probably will, if it continues and if stocks do sort of follow, if stocks are close to Fastmarkets expectations, then I would expect that that farmers will plant more soybeans next year than they did this year, and I would expect that basis levels will probably encourage that next year as well. So I put this in here really because I thought, oh, this is going to show that we may not have enough soybean stocks for Q3 crush. And it turns out it kind of tells the opposite story, but I also think that it highlights the importance of export volumes and how they're going to impact crush volume. Okay, so what does that mean for soybean prices and then ultimately soybean oil prices? This is just a simple comparing stocks to use, U.S. stocks to use versus the average price for these marketing years. And you can see kind of a pattern. At our biofuel conference in Europe, I got a question from somebody because I was predicting significantly lower soybean prices. And they were saying, well, if you look at the stocks to use, it actually implies higher prices. And I don't disagree with that. If you look at the U.S. stocks to use, that's well, I don't know. I guess I might still argue a little bit with that. Either way, it's probably better to look at the combined U.S. and South American stocks. That probably gives you a better picture. But for this one, the main reason I put this up here is because if you look at the years that I have highlighted, this year 22-23 and next year 23-24, and then 07, 08, 08, 09, and 13, 14, 14, 15. In all of those years, you had relatively tight stocks to usage, and you had one year where prices were really, really high. And then the next year, in 07, 08 to 08, 09, stocks actually got tighter. In 13, 14, 14, 15, stocks to use went up, but not way above not so much that it was just like, oh, now we're 100% comfortable with these stocks. They still remain obviously in the lower end of the historical range, but they did get a little bit bigger. But still, the movement in price was maybe outsized relative to the increase. 22, 23, 23, 24, we expect stocks and stocks to use to remain relatively stable, but we do expect significantly lower prices. However, those prices are not so far away from this trend line that you would say that our price forecasts are necessarily really, really low. Now, you can include a bunch of years and you can manipulate where the purple line ends up on the chart. I get that. That wasn't really what we tried to do here. We just tried to grab all of the years that we thought matched basically the current market structure in terms of participation by non-farmers, non-agricultural entities, and just the development of the markets over the last 20 years. And so this seems to me to be the relevant time period, and then the line falls where it falls. I do think that because of the tightness in the U.S. and the growth in demand for soybean oil, prices could be a little higher than they have been historically. So it wouldn't, if we shifted that purple line up a little bit, that wouldn't necessarily be something that I thought was crazy or wrong. And the impact that it would have on prices would be, I would sort of think the same about. So while we're predicting prices that are just a little over $11 a bushel on average for new crop, it could be that that is a little low, especially if U.S. crush and export demand is going to be really, really strong this year. All right, so let's talk a little bit about what the Fats and Oils report said about soybean oil use and what we think about going forward. So if I put this up because this shows the combination of soybean oil and canola oil used in biomass-based diesel production, and it's striking how much the trend has changed in this year, in 2023. That said, of course, there is a bit of this. There's probably a billion pounds of this growth that is driven just by the approval of canola oil's pathway to generate a RIN from renewable diesel production. If you think about it, it increased average monthly canola oil usage by maybe 100 million pounds. And so multiply that by 12, you get 1.2 million. If you subtract that out of Q3 or Q2, you get down to 2.9 billion pounds. So that makes it more in line with where we were. However, that change did occur, and we really are using this much vegetable oil to produce biofuel, and it's a significant difference. And we expect that it will continue going forward. And so we expect that for 22-23 total vegetable oil, so in this case, vegetable oil is just soybean oil and canola oil. Total vegetable oil use in biomass-based diesel production will be 7.3 billion pounds, of which 4.7 of that will be from soybean oil and renewable diesel, which is up almost 2 billion pounds. So you have the additional growth from renewable diesel demand, and you have the additional demand from canola oil generating RINs from renewable diesel. And the combination of those two get you this growth, which will have an impact on stocks and tighten stocks for potentially both soybean oil and canola oil, canola oil stocks are already relatively tight, so it's not, I don't, and they're already relatively small anyway. It's generally 200 million pounds or less, and so it's not the same as 2 billion pounds of soybean oil, where we can swing by 400 or 500 million pounds from year to year. For canola oil, it's maybe a 50 million pound swing. So it's not necessarily going to tighten canola oil stocks up a lot. However, it might change the composition of canola oil domestic use to favor feedstock demand a little bit more than I anticipated when we first started doing this. And even after that, once it became really clear that they were going to approve the pathway, we were closer, but we still underestimated canola oil demand for biofuel feedstock use. And so that really has been a bigger change for us than kind of anything else, is that increase in demand. The point here really is just to show you how strong this demand is, and also to kind of point out that if you have this much more vegetable oil demand for feedstock production, that it is going to have an impact on other use and on your ending stocks, because while production is growing, this is a significant jump in demand, and we also haven't necessarily seen a significant slowdown in non-biofuel demand. So this is a little different, but I wanted to include corn oil and palm oil in here because we're substituting in some cases for palm oil for soybean oil, or corn oil for soybean oil, or even canola oil for soybean oil. And the main point of this really is and it's a little tough to see. I got to improve this one a bit. It's a little tough to see, but in general, if you look over here at the very left edge, January, March 2020, we were at about 6 billion pounds of combined soybean oil, canola oil, corn, and palm oil usage. And if you come over here, January 2023, we're above 7 billion pounds. Now, we do expect that that as more soybean oil is used over the coming year in biofuel production, that means less in non-biofuel. That does tend to take this down. I think if you included the fats and greases in here, you would still see growth in non-biofuel usage. But the point here is really that despite that sharp growth that we saw in vegetable oil use in biomass-based diesel feedstock, or biomass-based diesel feedstock demand for vegetable oil, we're not necessarily seeing the kind of slowdown that we expected to see for non-biofuel. So I would have expected for this chart that you would have seen a much steeper decline in soybean oil usage, and the palm oil area would have grown much quicker. Now, we still expect palm oil to grow and canola oil to grow in total use. Palm oil probably will be much more focused will definitely be much more focused on non-biofuel use than anything else. And so it becomes a good indicator of, one, how strong is non-biofuel use, but two, how much is the feedstock demand sort of limiting the available supply, or at the very least the available supply that works economically for non-biofuel users. It's important to remember that for a lot of non-biofuel applications, that economically they can pay more than biofuel producers in theory, because soybean oil is a small portion of their overall cost structure. And so from that, if you think about it that way, the slowdown isn't maybe, or the lack of a slowdown isn't maybe as much of a surprise. However, at some point, I think we're just going to kind of run out of additional supplies of vegetable oils and fats and greases if the trends continue, where we really do start to bump up against our supply, and that really encourages the increase in canola acreage and soybean acreage and that kind of thing. I don't mean that like we run out and there's no supply response. There certainly would be a supply response in the commodities where there could be UCO on the fat and grease side. And when that happens, that will probably, I guess I should, if that happens, that would substantially impact the outlook not only for vegetable oils but for the fats and greases as well, and would suggest significantly higher prices for both. It seemed like over the last month or so that, or well, even a little bit longer than that actually, but really a lot over the last month or so, that maybe we had gotten to that spot with the fat and grease supplies, because you saw soybean oil prices falling pretty sharply and you didn't see the same response from fat and grease. Well, now fat and grease has broken a bit, and so it doesn't quite feel that same, it doesn't feel as tight as it is maybe I thought it was. But I do think that we still sort of are heading to that spot, primarily because there's so much demand for the fat and greases because of the advantages that they get from an LCFS credit perspective. That's only going to intensify as the industry shifts from the blender's tax credit to the IRA credits. And so I think there will come a time that we do run out of fat and grease supply, and that will put more pressure on vegetable oils to meet the remaining feedstock demand from biofuel producers. And so the point of this chart really is just to say that while it seemed like an easy prediction to make, to say as renewable diesel capacity grows and feedstock demand grows, particularly for soybean oil or canola oil, you could see a slowdown in non-biofuel usage until farmers have a chance to respond to higher prices or stronger demand and produce more. And again, I think that'll happen. And when it does, it will mean, at least in the short term, really, really strong soybean oil prices and canola oil and fat and grease prices. However, I don't think we're quite there yet, or at least I don't feel as strongly that we're close to that point as I did a month or so ago, when fat and grease prices were holding up despite a significant move lower in soybean oil prices. Okay, so this chart's another really busy chart that I put together. And what it shows is the stacked columns are components of domestic demand. So non-biofuel demand, feedstock demand for biodiesel, and then feedstock demand for renewable diesel, which includes co-processing in SAF production. And so you can see the growth in demand based on the growth in renewable diesel capacity, and a recovery, honestly, in biodiesel feedstock demand. And then the line portion of the chart represents the days of coverage. Days of coverage are simply the ending stocks from 1 month divided by the demand for the next month. So if something happened and we didn't produce any soybean oil starting the first day of the month, how many days could we go until we ran out of soybean oil? And you can see the sharp drop in August. And we expect that probably gets a little tighter in September before it starts to climb again seasonally, through next year, and then through next spring, and then starts to tighten up and get back down here again. And while August was way below the range that we've seen over the past year and a half, almost 2 years, it's really about the follow through and getting down to sort of that 20-day level. You can see in the past we haven't really broken in August, but August through December tends to be the tightest stocks get. And then as seasonally high crushing volumes catch up to the demand, then we start to build stocks relative to the demand seasonally, kind of starting in January, and we build to a peak. I think that in one of the things that surprised me a little bit was how high we went from the August low, which is 20, up to about 40 by April. That would be higher than we've seen in the last couple of years, and probably a little too high. I think that all probably moves down a little bit. I don't know that the bottom end of the range moves down a lot, though. And I think that production and in use and ending stocks in September and October will really tell us a lot about how low that number can get, and whether that will be enough to support a reversal in the trend in soybean oil. If we do get significantly lower, then I would assume that that soybean oil prices would find support and start to move higher. In the short term, they might do that anyway. They're maybe a little bit oversold, but I mean, a more sustained move, if not significantly higher, at least a more sustained move sort of sideways than we're expecting right now. If it turns out that the August data is just sort of a one-off, and we go right back up, then I think that that in the short term, you still might get a bounce because the market's a little oversold, but then you probably go and you establish the lower end of the new kind of equilibrium range, and that might be below 50 cents. So while this number is, while days of coverage is not it's not super accurate because of the real seasonality in a lot of years in the way that it moves, or if there's not big seasonal movements, it tends to stay a little steadier than prices, and so it doesn't necessarily look like it correlates well with prices. But I do think that it does tell a story, and it provides some insight into the areas that you want to watch to anticipate where prices are headed next. And so if the days of coverage deviate substantially from our expectations, either higher or lower, then that would certainly, after we dug into it, would have an impact on our price outlook. So again, while this is sort of like the stocks to use chart that I just showed, this is a pretty decent, it's pretty decent at providing some insight into where prices are going to go. However, it's not really great at predicting prices. And so it can give you, it can tell you that you need to look deeper into the fundamentals of the market. But it doesn't necessarily tell you that, hey, prices are going to move inversely to the movement in days of coverage. All right, and then finally, I wanted to put this slide back up for a couple of reasons. One, because we are just rounding the end of September and the beginning of October, and so it's the end of the month. And then, and so we really go through all of the price forecasts. We go through all the price forecasts every week. At the end of the month, we have to update fat and grease prices for the prior month and soybean oil prices for the prior month. And so we tend to take some time and look at our price forecasts a little bit more detail at the end of the month and kind of see if they make sense. And the last time I think I put this chart up, we probably had prices moving relative to soybean oil a little bit more than this time. However, it still looks like prices are probably going to the spread between soybean oil and most things is starting to narrow from historically wide levels, from record wide levels in many cases, and so it's starting to look like the pendulum is starting to swing back the other way, and we're probably going to get a period where fat and grease prices, especially I think in late 2024, could trade at a significant premium to soybean oil in some cases. And that's primarily driven by this idea that that we may be close to, or we may be using up a substantial portion of sort of the excess fat and grease supply, or the excess excluding biofuel feedstock demand. So if all other feedstock, or if all other demand relative to production kind of was what drove the market before the growth in biofuel feedstock demand, then the last little bit of the available supply that has gone into feedstock demand would sort of have been excess supply at that point. And that's kind of what I mean by that. All right, that is it for this week's presentation. Lots and lots of questions. All right, thank you for that. All right, let's get, oh no, you're kidding me. Damn it. I am sorry. Okay. Well, yeah, I apologize that you could not see my screen, and I can't see the questions when they come up. I'm sorry. I thought I shared it right before that. Joao's at a conference today, so he was not around to be able to let me know. I apologize. I don't understand exactly why that happened. If you want a copy of the presentation, email me and I will send it out. Really, really sorry about that. I got to figure out a way to get that so that when I'm doing that, I can see something else that tells me that that's not it. All right. On that terrible note, I guess we will end for this week. And yeah, if you would like the presentation, or if you have any questions, please let me know. Thank you. All right. Have a great week, and I'll see you back here next week.